The standard undergraduate model of a monopoly is a single firm restricting its output quantity to drive up the price. In advanced industrial organization, this focus on price and quantity leaves significant market behavior unexplained. Real monopolies engage in non-price competition. They engineer the physical nature of what they sell and manipulate how consumers perceive it. This is a standard demand curve. But the model changes when introducing two non-price variables, A for advertising budget and Z for product quality. These variables allow the monopolist to actively shift and rotate the demand curve, pulling more consumers into the market. To measure efficiency, economists use a theoretical construct called the benevolent social planner, an entity maximizing total social welfare, regardless of corporate profit. Contrasting a monopolist's mathematical optimization of advertising and quality against this social planner's benchmark reveals how monopolies systematically degrade both market efficiency and the physical products we buy. In 1954, economists Robert Dorfman and Peter O. Steiner developed a theorem for optimal advertising. Before this theorem, businesses relied on heuristics, setting budgets as a fixed percentage of gross profit or copying the sales ratios of their competitors. This 2008 working paper from the University of Magdeburg demonstrates that modern academic economics continues to use the Dorfman-Steiner condition to analyze a firm's marketing mix. The theorem solves a boundary problem, the exact point where an additional dollar spent on advertising stopped generating a profitable increase in demand. This equation provides the answer. On the left, we have the advertising to sales ratio, the firm's advertising budget divided by total revenue. On the right, the numerator is the advertising elasticity of demand, measuring how intensely consumers react to marketing. The denominator is the absolute value of the price elasticity of demand, measuring consumer sensitivity to price changes. This is the Dorfman-Steiner condition. The optimal advertising ratio equals the advertising elasticity divided by the price elasticity. As price elasticity gets lower, meaning it approaches zero, the optimal advertising ratio must increase. A low price elasticity means a firm has the market power to maintain a high price-cost margin, its Lerner index, without losing buyers. A common professional assumption holds that aggressive advertising is the tool used to create market power. The Dorfman-Steiner condition proves the causality is completely reversed. It is actually pre-existing market power that mathematically induces heavy advertising budgets. Monopolists advertise because their inelastic demand curve makes extracting further surplus from captive consumers incredibly lucrative. We can apply similar mathematical rigor to the physical lever, product quality, or the variable Z. Improving quality increases a consumer's willingness to pay, but it also increases the marginal costs of engineering and production. This chart illustrates how quality alters market geometry. Increasing quality from Z1 to Z2 causes the demand curve to rotate upward. At quantity Q1, we find the marginal consumer, the buyer who is indifferent between purchasing the product or keeping their money. Every buyer to the left of this point is an inframarginal consumer. These individuals value the product highly and would have purchased it even at a lower quality. The upward rotation of the demand curve raises the willingness to pay of these inframarginal consumers far more than it raises it for the marginal consumer. To maximize profit, the monopolist equates the marginal revenue from increasing quality with the marginal cost of producing that extra quality. However, the monopolist only captures the producer surplus. They ignore the uncaptured value given to those inframarginal buyers. The firm sets baseline product quality exclusively on what the marginal consumer pays for an upgrade, discarding the preferences of its loyal base. In multi-product monopolies, firms even introduce degraded, low-quality variants to prevent inframarginal consumers from trading down and paying less. For a monopolist, quality is a mathematical tool used to select the demand curve that yields the highest producer surplus. We can now test this quality choice against the benchmark of the benevolent social planner. The social planner's goal is to maximize total social welfare, the sum of both producer surplus and consumer surplus. This comparison shows a clear divergence. The monopolist focuses on the marginal consumer's valuation, while the social planner evaluates the valuation of the average consumer. Because the social planner includes consumer surplus, they evaluate a quality increase across the entire market. The planner will increase quality as long as the gain in total surplus exceeds the extra design cost. The monopolist stops improving much earlier, at the exact moment their captured producer surplus fails to cover the design cost. In the mid-1970s, economists Michael Spence and Spence-Sheshinski formalized this gap into a set of proofs. Their conclusion is clear. If the average consumer's valuation of quality is higher than the marginal consumer's, a profit-seeking firm will strictly undersupply quality. The monopolist distorts quality downward to induce self-selection and prevent high-value consumers from capturing too much free surplus. Because a monopolist cannot extract the full social value of a product improvement, they refuse to build the best possible version of that product. Stepping beyond price and quantity models exposes the mechanics of non-price competition. The Dorfman-Steiner condition shows that monopolists exploit inelastic demand by flooding the market with advertising to maximize extraction. The Spence-Sheshinski proofs demonstrate that they intentionally degrade quality to cater only to the marginal consumer's willingness to pay. The evidence of advertising and quality manipulation reveals a form of power that extends far beyond simple price gouging. Ultimately, monopoly power acts as a massive structural force, one that rewrites the core parameters of the market itself. Through non-price competition, a monopolist dictates the flow of information and the physical reality of the goods we use daily. In a monopolized market, products are not designed to serve society. Society is mathematically engineered to serve the firm.